Ladies and gentlemen, good day and welcome to LTIMindtree Q4FY25 results call. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I will now hand the conference over to Mr. Vikas Jadhav, Head Investor Relations, LTIMindtree. Thank you, and over to you, sir.
Thanks, Rutuja. Good evening, everyone. Welcome to LTIMindtree's Q4 FY25 earnings conference call. Today on the call, we have with us Mr. Debashish Chatterjee, Chief Executive Officer and Managing Director, Mr. Venu Lambu, Chief Executive Officer Designate, Mr. Nachiket Deshpande, President, Global AI Services, Strategic Deals and Partnerships, and Mr. Vipul Chandra, Chief Financial Officer. We'll begin by providing a brief overview of the company's Q4 and FY25 performance, after which we'll open the floor for Q&A. During the call, we could make forward-looking statements. These statements consider the environment as we see today and carry risks and uncertainties that could cause our actual results to differ materially from those expressed in today's call. We do not undertake to update any forward-looking statements made on the call. I now turn the call over to DC for his opening remarks.
Thank you, Vikas. Good evening and good morning to everyone, and thank you for joining us today. To start with, I'm pleased to mention that on the earnings call today, we are joined by Venu Lambu, who has rejoined us as CEO Designate on 24th January. Venu has worked closely with me for over a decade in the past. Since joining, he has gained deeper insights into the company's current operations and strategic planning. Venu will continue to focus on driving growth and enhancing stakeholder value. While I cover the performance highlights for FY25, I would request Venu to provide his perspective on the business outlook later. In terms of yearly performance, FY25 was a period of consolidation characterized by growth in our key verticals, growth across top customers, large deals traction, and significant progress in AI leverage deals. Despite robust revenue growth in the first half of the year, momentum slowed in the second half due to macro uncertainties. Nonetheless, as a strategic partner, we maintained close relationships with our customers and supported them in their cost initiative programs, while further consolidating our position with them. Overall, we achieved constant currency revenue growth of 5% compared to 4.2% in FY24. Revenue totaled $4.5 billion, reflecting a growth of 4.8% in US dollar terms. The strategic alignments with our customers have resulted in a robust order inflow this year. We recorded a Q4 order inflow of $1.6 billion, marking the second consecutive quarter with over $1.5 billion in orders. The total order inflow for FY25 stood at $6 billion, representing a 6.1% year-on-year increase. This exhibits our capability to continue to adjust our portfolio from a higher discretionary mix to longer-term efficiency-driven deals. Operating margins for the year stood at 14.5%, a decline of 120 basis points year-over-year. At the end of Q4 and FY25, our total headcount stands at 84,307, reflecting a net year-over-year addition of 2,657 employees. Attrition remains stable at 14.4%. Collaboration between academia and corporates is critical in times of technological transition. As a step towards this, we are excited to share that LTIMindtree has partnered with the Indian Institute of Management, Mumbai, to introduce the postgraduate program for executives in AI-led experience design. This year, This year-long program is designed to equip professionals with cutting-edge skills in customer experience design by leveraging the transformative capabilities of artificial intelligence. At LTIMindtree, we believe that true operational excellence is measured not only in metrics, but also in the trust we build with our clients. I am delighted to share that our CSAT score improved to 5.98 in FY25 from 5.85 in FY24, well above the industry average. I am glad to see LTIMindtree being included in the S&P Global Sustainability Yearbook 2025. This inclusion marks the first time we have been featured in the S&P Sustainability Yearbook and reflects our ongoing commitment to sustainability and transparent practices. The ongoing AI-led technology transition is enabling us to capitalize on new opportunities across various industries. Let me take you through some of the key wins in Q4. A leading US life insurance company has engaged us to enhance its quality processes using AI to improve the operating model, thereby advancing enterprise quality engineering maturity. This is a multi-year deal which will focus on enhancing quality engineering practices and leveraging AI to transform the operating model. We have been chosen by a global reinsurance group to enhance efficiency through an AIOps model as part of its end-to-end outsourcing deal. A leading digital company in the Kingdom of Saudi Arabia region has entrusted us with the providing end-to-end operations services for their hybrid cloud security platform. We have been selected by a global entry major to provide next-gen ERP support services across multiple functional and SaaS-based solutions. Our year-end deal pipeline continues to remain robust. Next, I will discuss our industry verticals performance. Our primary verticals, BFSI, technology, and manufacturing, which accounted for approximately 80% of FY25 revenues, experienced good growth this year. The technology, media, and communications vertical contributed 24.5% to FY25 revenues and grew 8.7% year over year in US dollar terms. We see continued momentum in this sector. Our largest vertical, BFSI, which contributed 36.1% to FY25 revenues, grew 4.6% year over year. Client priorities continue to revolve around regulatory commitment and data transformation for better reporting and decisions. During the year, we closed several large deals in this vertical, primarily focused on cost optimization, vendor consolidation, and tech modernization. The manufacturing and resources vertical, which contributed 19% of FY25 revenues, grew 7.2% year over year, aided by the large deals we signed earlier this year. Demand was driven by vendor consolidation, ERP transformation, and managed services deals. Our consumer business, which consists of retail, CPG, travel, transportation, and hospitality businesses, showed flat growth year over year in constant currency terms. Retail and CPG witnessed growth during the year, while the TTH portfolio had a couple of client-specific slowdowns. Our health, life sciences, and public services business, our smallest vertical, declined by 3% year over year. The decline primarily came from the healthcare business. In terms of geographies, North America grew by 7.1%, Europe declined by 1.2%, and the rest of the world declined by 1.7% in FY25. I will now turn over the call to Vipul for the financial highlights.
Thank you, DC. Hello, everyone, and thank you for joining the call. Let me take you through the financial highlights for the fourth quarter and financial year 2025, starting with the revenue numbers. We ended the fiscal year 2025 with revenue of $4.5 billion, registering a growth of 4.8% in dollar terms and 5% in constant currency terms. The EBIT margin for FY25 was 14.5% compared to 15.7% in FY24. The PAT margin was 12.1% compared to 12.9% in FY24, while the absolute PAT for the full year was INR 4602 crores, an increase of 0.4% over FY24. Cash generation for the year continued to drive the strength of our balance sheet, with operating cash flow to PAT at 98.8% and free cash flow to PAT at 78.5% for the full year. We closed the year with an all-time high cash and investment balance of $1.56 billion or rupees 13,346 crores compared to rupees 12,488 crores in Q3 FY25. Return on equity was at 21.5%. For the fourth quarter of FY25, our revenues stood at $1.13 billion, up 5.8% year over year in USD terms. The corresponding constant currency growth was 6.3% year over year. Sequentially, revenue declined by 0.7% in dollar terms and by 0.6% in constant currency. EBIT margins for Q4 were flat at 13.8% compared to Q3. Despite the sequential revenue decline, we were able to maintain margins due to improved operational efficiencies. PAT margin for the quarter was at 11.5% as compared to 11.2% in Q3 FY25. Basic EPS was 38.1 rupees for the quarter as compared to 36.7 rupees in Q3 FY25. The effective tax rate for the quarter remained stable at 26.2%. We remain committed to reducing our days sales outstanding as evidenced by the improvement in total DSO, which reduced by 1 day, bringing it to 79 days for Q4 versus Q3. As of March 31, 2025, our cash flow hedges stood at $3618 million and hedges on the balance sheet were $259 million. Corresponding numbers for euro hedges stand at euro 145 million and euro 28 million respectively. Our utilization, excluding trainees, in the quarter came in at 85.8% compared to 85.4% last quarter. Our attrition continues to be stable. For the quarter, our TTM attrition was 14.4% compared to 14.3% last quarter. We onboarded over 4,700 freshers during the year, which is another step on our pyramid correction journey. The Board of Directors has recommended a final dividend of rupees 45 per share, subject to shareholders' approval, taking our overall dividend for the full financial year to rupees 65 per share. Our commitment to sustainability remains steadfast. Let me outline some of our accomplishments on this front. I'm pleased to announce that LTIMindtree received the India Green Award 2025 for demonstrating best practices and achievements in sustainability reporting. LTIMindtree was also awarded the prestigious Zero Waste to Landfill certification for 2 of our Mumbai offices in Powai and Mahape. We proudly stand as the only Platinum Award winner in the Sustainability Report category within the technology IT services sector. This achievement underscores our leadership in sustainable practices within our industry. LTIMindtree attained the Global Leadership League in CDP Climate Change 2024 for the 5th year in a row. I'm also pleased to report that CRISIL has reaffirmed its rating on the company's bank facilities as CRISIL AAA stable and short-term facilities at CRISIL A1+. I would now like to invite Venu to share his thoughts.
Thank you, Vipul. I'm very excited to rejoin LTIMindtree. The transition has proceeded smoothly, and it has been a rewarding experience collaborating with DC once again. Over the past 90 days, since my rejoining, I have traveled extensively to various locations, engaging with both employees and customers. I have participated in over 100 meetings involving customers, industry experts, partners, and investors. These engagements across stakeholders over the past 90 days have been quite reassuring and reinforced my commitment to value creation at LTIMindtree. The recent macro uncertainties will take their own course. Over the past 2 decades, we have faced various challenges and emerged stronger each time. We see the current phase of technological transition and macro issues as another opportunity and are confident in our ability to thrive. I would like to outline 3 key initiatives that we have prioritized as we move into FY26. The first initiative is sales transformation. This centers around simplifying the service line sales structure, strengthening leadership in high potential businesses, reimagining value creation with our partners and customers, and exploring new sales models in the AI economy, targeting a larger portion of clients' cost base than just IT. As we move into this AI-driven economy, clients are increasingly seeking multi-service, multi-delivery, and multi-geographical solutions. This significant shift in demand necessitates the development of an innovative playbook, prompting us to revamp our large deal organization. The framework for this organization, in the context of AI, differs significantly from the traditional methods. It focuses on proactive integration of new age technologies into clients' IT system, as well as our own service delivery processes. To boost our scalability in this evolving landscape, we have devised a robust go-to-market strategy spearheaded by Nachiket Deshpande, President of Global AI Services, Strategic Deal and Partnerships. Nachiket will now be based in US, and his experience across the value chain will help in delivering integrated solutions that resonate deeply with clients' evolving needs. While the first 2 initiatives focuses on revenue maximization, the third initiative, Fit for Future, primarily aims at enhancing agility and profitability. It involves rebaselining of our operational cost, both direct and indirect. The goal is to relook at the existing team structures and alignments, processes, and reshape them towards reducing the extra layers where possible, leading to an agility and operational efficiency with the innovative use of AI. The program will target productivity improvement in all areas like sales, delivery, and business enablement units, maintaining an optimal and efficient bench processes. And it's also optimizing span of control and etc. It should start yielding results through the margin improvements during the year. In conclusion, we are confident about navigating the macro challenges as we move into executing our growth plan for FY26, and we expect our Fit for Future program to help improve the margins from Q1 onwards. With that, let me now open the floor for questions.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Sulabh Govila from Morgan Stanley. Please go ahead.
My perspective is from an organization point of view, the changes that you highlighted. Would you say that these changes have already been in place, especially with respect to people, or you think that that is something that will take some time to play out? And secondly, within that, the areas that you mentioned about sales transformation as well as targeting margins, what among these could be some of the quick wins that you will target in the first year, and what could be some of the longer areas that you will pursue?
Sulabh, I think, on the first part, the organization structure is final. I think, the organization that was in place, we're just strengthening that, improvising in the areas where we need to do it. but the focus is actually to continue and accelerate the momentum. So that's number one. The second thing, the areas that I spoke of with regard to the Fit for Future program, some of these initiatives are already running, as I entered into the organization. It's just that I brought it under one overarching umbrella and overarching program and driving it with that governance and focus. So it's something which is already work in progress. So it's not something that we have started in fresh. It's just that it got extra focus and extra rigor.
It got expanded a bit in the last quarter.
Yeah. Did I miss out the other question? Okay, which ones will give results with regard to the second part of the question on the sales transformation? Our expectation is that both should start giving quick win results, right? Again, sales transformation is not about overhauling this, sales structure. It's about getting better, on what we are doing. I think there is a chance to improvise our playbook as the client expectation changes, and that's what we are focusing on. So, the word transformation may look like a big thing, but, you should read it as an improvisation from the overall sales effectiveness standpoint. And, we're confident of start getting some quick results on both these initiatives.
Understood. Thanks for that comprehensive answer. The second is, the outlook on the top two clients that we have, given that, especially on the high-tech client, should we expect the productivity benefit pass-on phase to be over? And one should expect that client to grow this year? And in the banking client, given the changes that client is pursuing internally, what areas would you think are relatively protected, and what could be at risk?
Look, I think on the first part, on the productivity part, I think as DC would have briefed in the Q3, that's been factored already in the Q3 and Q4 quarter. So that's the end of the initiative we are driving, and we're happy that we successfully delivered those benefits to our customers. So that's, a sort of a closed topic in that regard. Look, it's a customer where we had a relationship over many years, and we'll continue to, work with them in developing new capabilities and areas to grow. The second one is, you asked a question with regard to the banking. Look, I don't want to comment with client-specific news that you're talking about, but I can only say that, we continue to see an increased opportunities in our clients across all the top clients that we're engaged with. So I don't see any immediate risk on that.
Understood. And last one from me, with respect to the current demand environment and the visibility that you have. So the macro uncertainty that's been playing out over the past few weeks, would you say that that has had some impact in the month of March, and that's continuing in April, or you've not seen anything like that in the past few weeks?
Look, I'll comment on that. DC can add if you anything extra on that.
Okay, go ahead.
Sorry. Look, I think the uncertainties that was there in Q4, I don't think it has disappeared as we step into the Q1, right? So I think it still persists in various forms and shapes. So that's one part of the answer with regard to where the uncertainty lies. The second is, where do we see the demand outlook coming from the client? I would say, look, it's predominantly coming from the three areas, right? Even the clients are navigating the same uncertainties that we are navigating. So they're looking for opportunity to save cost. So there are opportunities where we can help customers in cost-saving opportunities. The second is, this is also an opportunity for our clients to actually simplify their vendor landscape. So there is a huge vendor consolidation, demand out there. So it's an opportunity for us to be competitive and get a bigger share of that. And the third is that as most of our clients navigate to the AI economy, they need to modernize their tech as well, right? So especially if you want to pivot and scale at AI, it requires a tech modernization. So these are the three, sort of an archetypes of demand that we see, which are pretty much contextual to the uncertainties that even our clients are navigating it.
Understood. Thanks for taking my question, and all the best for this financial year.
Thank you, sir.
Thank you. The next question is from the line of Abhishek Bhandari from Nomura. Please go ahead.
Yeah, thank you for the opportunity. I had a few questions. So when you welcome back home, from the time you left LTI, the time you rejoined, and the last 3 months you spent in the company, what are the areas you think have changed, where there's a need for an immediate attention? And what are some of the areas where you think things have improved since the time you left? The background of this question is some of the expectations what investors had in terms of growth being A plus B after the merger hasn't really played out. So answer will be right.
Yeah. Firstly, Abhishek, thanks for welcoming me back. Look, on your question, to be honest, I don't think it's fair for me to analyze that way because I was there only 1 month after the merger, so it's very difficult for me to have a reference point and do that. But we also need to understand, I'm sure you appreciate that the market we were talking 2 years or even 3 years back is completely different from the market that we talk today. The client expectations have changed, right? And their spend areas have changed. And coupled with that, even the technology advancement, right? And the kind of AI conversation we could have had 2 or 3 years back versus today has fundamentally, has changed. So that's only how I look at from an external standpoint. But, from an internal standpoint, it's the same organization. I have a very talented team and, great leadership, and we're all passionate and determined to deliver the growth. So at least on that aspect, I can assure you there's nothing that I've seen a different change. If not anything, probably I would have seen more hunger and, more passion to deliver growth. Thanks to DC for that. Did I answer your question, Abhishek?
Yeah, partly I think maybe in coming quarters we'll have very more clarity on the strategy and how it's built out. I appreciate it just in a few months for you. The second question is, on the headcount number. In this quarter we had a very sharp, headcount reduction. So maybe if you could guide us, how one should think about, the linkage between your expectation on growth and headcount addition going forward.
Nachikeet.
Yeah. So this quarter, if you actually see the reason for a sharp decline in the headcount it sort of should be seen in the context of Q2 and Q3, where we had built aggressive headcount increase in the anticipation for the growth, and we kind of worked on deploying that in Q4, and hence you see the net headcount reduction. But going forward, as the AI-led productivity starts to play out, Abhishek, we would expect that the headcount growth may not be linear with the revenue growth that we seek. So there would continue to be that play as we go along and as the AI adoption increases across our services.
Got it. Thank you for that, Nachikeet. And my last question is, should we expect the usual seasonality for you to play out even in FY26, based on the order book closure and the pipeline what you have? Or is it slightly different this time given the macro world?
So Abhishek, we could not hear the first part of the question. Could you repeat that, please?
Should one expect the usual seasonality of your business to play out in FY26, based on the order book closure what you have and the pipeline you have? Or you think the pattern could be different this year because of the uncertain macro?
Well, the seasonality variation that you see in our quarters from the last year, I think in my view it will be more or less the same, right? If at all, if there is anything that we can add on top of it is our ability to respond to the clients' new types of demands and helping them in all the 3 areas that I mentioned. So that we need to see how that gets played out, and also how long this uncertainty environment stays throughout the year. So those are the two sort of variables outside, I would say.
Yeah. Got it. Thank you very much and all the best. And DC, thank you for your time in the company.
Thank you. Thank you, Abhishek.
Thank you. The next question is from the line of Sandeep Shah from Equirus Securities. Please go ahead.
Yeah, thanks for the opportunity. You spoke about the client-specific issue in terms of both high-tech as well as in BFSI. Apart from that, is there any other client-specific issue, especially in a vertical like insurance or in travel, transportation and hospitality, where vendor consolidation, we may win some, we may lose some?
Look, firstly, Sandeep, I don't think I spoke about any issue as such. If at all, I actually gave an assurance that, the productivity part of our top client, that we have executed successfully, so we don't see that flowing into the Q1. That's the point one. And second thing was a question was regard to the banking client, where my commentary was more about how we continue to see, opportunities with our clients as we go along. So, not sure if I missed the context, but there are no specific issues that I highlighted.
No, outside of these two, what I wanted to know is there any top client-specific issue in travel as well as in terms of insurance because of California fire and exposure of some of our clients more towards California?
Okay, thank you. Sandeep, sorry, the line got disconnected all of a sudden. Look, with regard to your questions on insurance and travel, look, I think travel, as we called out, there were a couple of client specific instances that, had an impact on the FY25 numbers. And these are the clients that are actually planning new initiatives. At least, I could sort of say that in the near future, there are no other new impact on those clients that was already taken care in FY25. In terms of the further demand outlook from those clients, we have to just wait and watch for a couple of quarters as such.
Okay. And just a strategic question, Venu, when you are joining back the company, there has been a dual problem in terms of growth being lower versus what it used to be LTIMindtree versus peers. And second, margins are also at a very low level, despite some of the levers have been used out in the last 3 to 4 years. If you look at gross margin, is at all-time high and is one of the lowest in the industry. So in terms of focus, do you believe driving both the initiative concurrently could be a difficult job and you might have compromised one for the other? What is your strategy in regards to this? And second, as a clarification in terms of service line transformation, so is it one can understand the GTM model may change from vertical focus to service line focus?
No, firstly, let me clarify that part. No, it doesn't mean that. What it means is that the clients are consuming service capabilities in a different way these days, Sandeep, right? It's no more consuming a part of one service line or anything. Most of the construct, whether it's the tech modernization, cost saving, or the AI kind of a need, involves more than one service line. So when I spoke about simplifying, it's about making sure that we become more agile and become more competitive in the way we address the market with regard to the service line sales capability. That's the the first part of it. And second thing is that with regard to, playing on both the tracks of revenue and margin, I think, it's something we have, the capability. It's not the first time, we would have addressed these challenges, right? So we have all the capabilities and we have the teams, who can navigate this, this both. And our endeavor is actually to drive the profitable growth. So hence we need to get both. I don't think you can get the profitable, you can get the profits by just cutting the cost. So, you need the revenue and the volume as well. So it goes both hand in hand. I know it's always looks challenging, but I think that's where we have a great leadership and team in place to deliver that.
Okay, thanks. Congratulations, Venu, and all the best.
Thank you.
Thank you. The next question is from the line of Manik Taneja from Axis Capital. Please go ahead.
Hi, thank you for the opportunity and congratulations, Venu, for rejoining LTIMindtree. So my question was with regards to the commentary that was provided post your third quarter results, where you were quite optimistic about sustaining the growth momentum, driven by a combination of factors. If you can talk about where were you negatively surprised in terms of verticals with the way how Q4 panned out. And the second question is with regards to the sales transformation that you're talking about. You've seen a number of exits in the organization in the course of recent months. Could you talk about how you're looking to backfill some of these positions and the likely timelines to it? Thank you.
Yeah, I think the first part, I would request DC to comment and come back on the sales transformation.
So Manik, the way to look at it is that we had a strong growth in Q2, and we also saw a good order inflow in Q3, which kind of made us believe that the volumes are going to come in for which there will be good growth in terms of Q4. But obviously, multiple factors, mostly macros, as you are aware of, which kind of played a role in terms of two aspects. One is many of the deals that we closed, which were supposed to start, they did not start in the same way. The ramp-ups were delayed. And secondly, some of the deals which were expected to close in Q4, they also kind of got carried forward into the next quarter. So these are some of the factors that did not play out the way we had anticipated. That is why you will see that there was a well-planned in terms of if you look at the intake for Q2 and Q3, the intakes were high, but we could not really ramp up the way we wanted. But of course, the good news is that some of those deals will get closed in this quarter, so you will hear about it as we go along. But otherwise, that is primarily the reason why the growth momentum could not continue though we had anticipated. And on the sales transformation, let me hand it over to Venu.
Thank you, DC. Look, I think on the sales transformation, as I mentioned, it is more about getting a better version of ourselves in the context of the new playbook or in the new AI economy, right? So that means we already have a great sales team, and we have a very effective way of managing our client relationship, and we're sort of infusing with the new playbook that is needed in the context of AI economy. So that's how I look at the sales transformation, and all our industry leadership and everything is constant and is steady. So there's been no exits in that part of the organization, and one or two exits that we had, we have backfilled it very successfully. The growth office, we consolidated under one leader now. We have a global chief growth officer, and we also integrated the vertical delivery as well under one single chief delivery officer. So I don't think we have any risk with regard to the exit. In fact, we have a good interest for the leadership infusion as we start growing as well. So.
Sure. If I can chip in with one more question. This question was for Vipul. With regards to our Fit for Future program, we're talking about some of the easy wins come through very quickly in FY26. If I look at your cost split up over the course of FY25, we've seen our non-manpower expenses come off meaningfully over the course of last couple of quarters. If you can talk about what exactly has driven some of those efficiencies and how should we be thinking about these expenses on a go-forward basis?
So I think, Abhishek, as we said that under Fit for Future program, we are targeting, agility and cost optimization, and there are many tracks in that program that we are simultaneously focusing on. So some of the tracks which have started yielding results are in terms of the overhead side, which you have seen and you have yourself commented on in the SG&A side. I think some of the other initiatives which are going to start playing out will be in the manpower cost area also, as we address the span of control and also the optimization and driving the efficiencies in the workforce management process and the talent process. And we are also, as we are adopting AI more and more, we have already said that the increase in headcount versus revenue may not be linear going forward. So I think all of these levers playing together is what we are looking at. Some of them have already been in place. Some of them will start kicking in further now.
Sure. And any targets or any timelines that you're giving to the margin improvement aspiration?
Abhishek, as you know, we don't give a guidance per se for the future, but I think in terms of the timelines or impact, that will be visible through the quarters in FY26 as we go along.
Yeah. It's a journey which will start getting visible from Q1 onwards.
Yeah.
Sure. Thank you. All the best for the future.
Thank you.
Thank you. The next question is from the line of Vibhor Singhal from Nuvama Equities. Please go ahead.
Yeah, hi. Thanks for taking my question. Venu, I had a question on the strategy that you mentioned about the various initiatives that you are taking in terms of a chief growth officer and the revitalization of the employee workforce. In terms of the target that you are looking at, these strategies to achieve that target, is there any target in our mind, a North Star maybe, that we want to basically achieve this kind of a growth, if not numerical in absolute terms, in terms of relative to peers or industry? Similarly, on the margins front. So are there any targets or North Star that you're looking at? Or if you can't share them with us at this point of time, is there a timeline that we would be looking to share that, okay, this is what we aspire to be in X years of time or whatever that time frame could be?
Yeah, look, I think, in the short term, it's about getting the growth in the first quarter, which I feel, we are reasonably confident of achieving that, right? And in the medium term for the full year, I would not comment on any specifics, but I think I will live up to the spirit that DC has been advocating over the years of industry-leading growth. I think that's what our endeavor will be to achieve that. But as I said, in the short term of the Q1, as I see it, I think I'm reasonably confident of getting that growth.
Got it. Also, just a couple of questions on on the outlook and just specifically on the Q4. We've heard a lot of our peers talk about heightened level of uncertainty in the manufacturing and retail vertical. These two are key verticals for us, and of course, the impact of the uncertainty is mainly because of the tariffs. Is that also what is kind of reflecting in our conversations with them, or do you think it's nothing as of now has come up with them? And your outlook for these specific verticals, let's say, in the near to medium term?
Actually, you can't generalize it across the sector because it depends on where the client's operations are, where their supply chain is, where do they sell, and so on. So it becomes very difficult to generalize it. But I can tell you how our demand is looking on these two sectors, right? And manufacturing, I would sort of phrase it as, a steady and growth-oriented in the short term. That we can say. In retail, we have very exciting conversation going on some of the strategic deals and strategic engagement. So there has no been material request. There is no material request that has come to us at the back of the tariff changes. But the fact about discretionary spend is still muted. That still remains the same as what it was in the previous quarters. And clients are adopting wait and watch. But the three areas that I called out in the beginning about cost saving, vendor consolidation, tech modernization initiatives, across these three areas, specifically these two sectors, I would rephrase the way I said it. Steady and growth in manufacturing, retail, some couple of exciting engagements, that we are in the discussion.
Got it. Just one last bookkeeping question. The healthcare vertical, though it's a small one for us, saw a very sharp decline in this quarter, both on a Q1Q and Y&Y basis. We almost lost $10 million of revenue on a quarterly run rate basis in this quarter. Any specific thing to call out, any client-specific issue which might reverse in the next coming quarters, or anything on that would be really great?
No, I think, there is no client-specific issue per se. Most of the business in healthcare is healthcare and public services is project-based, and there are these project-based business-related cyclical impacts in the public services. That's all about it. There is definitely no customer-specific issue.
Could it be a DOGE impact that the government of US is leading the initiative?
No, most of the work we do in public services are in all India, so there is no impact like that. There is no DOGE.
No impact. Got it. Thank you so much. Thanks for taking my questions, and wish you all the best.
Thank you.
Thank you. The next question is from the line of Abhishek Kumar from JM Financial. Please go ahead.
Yeah, hi, good evening, and congratulations, Venu, on your new role. My question is, it's a difficult environment to execute transformation of any company. Any macro that you have kept in mind, or how contingent is your transformation program on the macro? Have you baked in similar macro, any deterioration? Or in other words, what can derail the transformation strategy or delay this?
Okay. First let me clarify, the question with regard to the transformation, right? Let me define what are we focusing as an organization, right? So, look, we have a lot of things already in place. We have great capabilities, fantastic clientele reference base, and the successful engagements across many years and so on. So, thank you. Abhishek, I don't know till where you heard me, otherwise I could start from the beginning.
Yeah, I think it's better if you can start from the beginning, sir.
Okay. All right. Thank you. Look, I think firstly, as I said, I just want to, re-baseline or contextualize the transformation question that you said, right? The way I look at it is the very fact that I come back to an organization which is familiar to me, right? I know the people. Of course, I worked with DC for many years and Nachiket and other leaders for quite a few years. So we're looking at ourselves as how do we get better with our own version? I call it as, can we become a better version of ourselves? So transformation may look like a very heavy lifting, multi-year theme kind of a narrative. That is not what we are at it. What we are at it is identifying specific areas where we can get better, right? And Fit for Future is, for example, is one area. I think there is an opportunity for us. We can get better at the cost, right? And we need to get better at the cost, again, because of the macro uncertainty and also because an opportunity that AI has given us, to re-baseline certain element of cost. So we're bringing all that under one umbrella for Fit for Future. So that's a very specific thing, not related to the external environment, hugely in our control to deliver that. The second thing is that with regard to the sales transformation that I spoke of, again, it's about how do we ensure that we give newer playbook to our sales leadership? How do we give new sales capabilities to our sales organization? And that's not a one-time affair. That's an ongoing thing. We just kicked it off, and it will go on throughout the year and beyond. Again, that is pretty much in our control, right? So there's only one thing which is outside of our control is the demand outlook, and that is not included as part of transformation. So that's why I would sum it up that the things that we are focusing on to get into a profitable growth curve is all lot in control minus the macro uncertainty, both in terms of how long it will remain and in what shape it takes.
Understood. My second question is on the growth outlook for FY26. DC, you said, roughly 6% of TCV growth this year. At the same time, there's a shift from discretionary spend to longer tenure deals, or cost takeout deals which are longer tenure. And then we have probably full year impact of productivity pass back coming in FY26. So fair to assume that the growth could be lower than 6%, or just in terms of whether FY26 could be similar, better, worse compared to FY25. That would be helpful. Thank you so much.
Look, I don't want to give very specific range or something because we don't give those guidance. But I can only tell you that order booking momentum will continue. It will only go up from the last year. And as I did indicate, we are at the very interesting and exciting phase of conversation with a couple of large clients in the retail sectors. And so we will have a couple of large deals, update that we may share it with you in the due course. Right. But at the moment, I'm very optimistic that the order book will be higher than the last year.
Okay, great. Thank you and good luck.
Thank you. The next question is from the line of Mihir Manohar from Carnelian Asset Management. Please go ahead.
Hi, thanks for giving the opportunity. And congratulations to Venu on joining back. Largely wanted to understand on the margin hit, margin impact which has been there over the last 7-8 quarters when we see. So essentially, I think the hit is largely coming from gross margins. Now, even utilization has remained largely flat. On-site offshore ratio has remained in that range of 14-15%. Which essentially means that either there is a pyramid has gone bad over the last 8 quarters, or there is a pricing reset itself, there is a margin reset itself, which has happened in the business. So throw some light, what is causing this margin impact, which is there over the last 7-8 quarters? Is it the pyramid getting really bad, or is it the new pricing itself getting adjusted?
So in terms of the margin, having deteriorated over the last few quarters, I think in quarter 3 also we had called out that the impact of wage hike, which we had implemented from 1st October, had kind of affected the margins in Q3, and the impact of that has continued in Q4. At the same time, we had started initiatives on margin improvement, and which we talked about earlier. So in spite of the revenue growth not coming through in Q4, we have managed to maintain our margins. So I think it's we can say that we have bent the cost curve by taking some initiatives. Yes, pyramid correction is one of the levers that we are focusing on, and we have been focusing on. Span of control is another lever that I talked about. So there are multiple levers that are being focused upon as a part of our Fit for Future program, and we are confident that they will start showing impact from Q1 onwards. But it is a journey, and we will have to undertake that journey over the next few quarters.
Sure. Is there with respect to the large high-tech client which is there, is there a pricing reset which has happened, which has impacted margins?
There is no pricing reset as that.
Yeah. It was productivity passback as we had called out in Q3, and that is what it was. And as we had said in our Q3 earnings call also, it had not affected the margins of our segment. So there is no pricing reset. It is a productivity passback which we have done and successfully delivered.
Correct.
For sure. And my second question was on the deal win side, and 2 quarters of good deal wins. I understand the situation is a dynamic situation, but when should one expect these deals to see some impact on the revenue side? And specifically, if you can highlight, how is AI helping us over here in getting deals, that would be really helpful.
Look, I think we spoke about delivering growth in Q1, so part of it should get reflected in Q1, and I also spoke about sharing a further update on some of the couple of strategic deals pursuit that we are in, which is what we would share in the due course. So that will start reflecting from Q2 onwards. So that's how I would say. Vipul, anything further you want to add?
I think we covered it.
Sure. That's it from my side. Thank you.
Thank you. The next question is from the line of Kumar Rakesh from BNP Paribas. Please go ahead.
Hey, hi, good evening, and thank you for taking my question, and welcome back, Nehu. My first question was to better understand the growth trend during this quarter. So when we entered this quarter, we were expecting the growth momentum to continue. And through the quarter, as you spoke about that some of the deals didn't close and the ramp-up got slowed down, the impact seems to be about 2.5 percentage point, which is higher than what your peers have seen the impact in the quarter. Actually, many of the peers have spoken about that they haven't seen any impact. And going into the quarter, you were building headcount as well, expecting that growth to play out. So first part of the question is that what resulted into the impact in your business to be higher than peers? Because you also spoke about that manufacturing and retail where you are over-indexed, you haven't seen material impact to be there. So what exactly is it that resulted into your growth being impacted more than peers? And now as we are entering into the first quarter, your headcount is much lower while you are speaking about that you're confident of growth. So what essentially is driving that confidence going into the first quarter that you would be able to deliver growth?
I'll answer the second part.
Yeah. So let me take the first part. So when you remember when we had our earnings last quarter, we had very clearly called out about the fact that we have to pass on some productivity benefits for one specific account, and it exactly played out the way we had anticipated. And the good news is that we have kind of completed that exercise in Q4, so there is no overhang of that going into the next quarter. Having said that, we also expected the volumes to increase in the other parts of our business. And that is what I think I elaborated in my earlier answer, that we signed a lot of orders. The order book was very healthy, but the ramp ups did not happen the way we had anticipated. And predominantly factor could be the macro situation. That's one. And some of the deals that we should have closed in Q4, they are also kind of getting shifted to the Q1. So Overall, the long story short is that the ramp-ups did not happen. The volumes did not come the way we had expected, though we had, in anticipation of that, we were well prepared. And that's predominantly the reason why we did not, meet the expectations that we had set. But having said that, as Venu articulated, we are very confident that as we get into the next quarter, the two things will happen. One is we'll be definitely able to talk about a few new deals, and second thing is we are very confident of the growth coming back. So when you want to answer the second question?
I think some of the deferment topic that we spoke about, or some of the the decisions that got slightly deferred, is also one of the reasons why we'll start seeing that coming up in Q1. But I think if you look at it in the Q4, the way I see it from the market standpoint is most of the clients were was sort of a wait and watch mode in JFM quarter. I think in the coming quarter, at least the conversations have started happening, right? Yes, they're cautious. They are waiting and watching on some big decisions, but things are not standstill. So there are still opportunities in the areas that I highlighted, earlier, and these conversations are happening. I think the JFM was a quarter where a lot happened within this short period of time. So it was, I think, probably too much for our clients as well to sort of comprehend and then act it. But I think now, I'm not saying things are getting clearer, but as the things continue to remain as it was before, I think it's an opportunity for people to start finding a way to start doing business, specifically in those three areas. And we see the continued traction of those 3 years. That's why I'm confident about getting back to growth in Q1. And and also I highlighted a couple of large deals, where if I may take a risk of saying we're favorably positioned, which we will announce it in the due course, and those large deals are also the reason that I'm confident of Q1.
So just a clarification on those comments. So you spoke about volume took a hit in this quarter. So the revenue decline that we are looking at, the volume decline was similarly lower in the quarter?
Sorry, which one are you referring to, Abhishek? Sorry, I didn't get it.
So the sequential revenue decline that we have seen in constant currency basis, your volume also had a similar decline in the quarter?
Yeah, it was more or less the same. Yeah.
Understood. And my second question was, in the past you have, although not given guidance, but you have been quite confident about talking about that the company's growth would be peer-leading growth. Are we confident enough to at least speak about that for FY26, that we should be able to match or lead the peer growth, or the uncertainty is too high to make that comment at this stage?
Yeah, look, in the given situation, I will take it 1 or 2 quarters at a time, before sitting here giving the full year commentary. So that's why I've been consistent in this call that do we see a growth coming back in Q1? Absolutely, yes, we'll see that coming back. Do we see margins getting better in Q1? Yes, we see the margin getting better Q1. But as we get more and more clarity and, both with our clients and outside environment, I think we can extend, we can give a further extended commentary beyond, a couple of quarters. At the moment, that's probably I would stop.
Makes sense. Thanks a lot.
Thank you. Ladies and gentlemen, that was the last question. On behalf of LTIMindtree, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.